Joining us right now, Ron Temple is the chief market strategist at Lazard. And amidst all of the questions we have about tariffs and the like, what would you do in the market?
Well, I think the markets are still in a bit of a state of denial in terms of what's going on with tariffs. You know, every week we seem to kind of get hopeful that maybe they won't be as bad as we expect. But as you've been reporting this morning, you know, speculation of a universal 20% tariff. These are really big numbers. And just to put it in context, on January 19th, the weighted average tariff in the U.S. was 2.7%. With everything announced so far, we're up to about 10.9%. So, you know, 8.2 percentage increase. And by the way, those numbers are not as precise as I would like because still not clear how much of Mexico's exports to the U.S. will be covered, how much of Canada's. But basically, we've unwound about 60 to 70 years of tariff reductions in two and a half months. Now, the way I think about that is every 100 basis points you raise that weighted average tariff is about 10 basis points of core inflation. Takes months for that to show up. Obviously, a lot of importers tried to front load their purchases before the inauguration, knowing tariffs were coming. So I think you're going to start to see this in inflation when you get to May or June. And why I'm going through all of this is that's the inflation. Then the GDP impact really occurs. And at some point, corporate profits do get affected, corporate margins, because, you know, when you go to Walmart or Target or Costco, when the prices go up by a material amount, you don't buy as much.
But you don't think that's reflected in this equity market right now?
I don't. I think there's still more risk to the downside. And by the way, we haven't even talked about retaliation, right?
How much more risk to the downside?
No, I could easily see another 5 to 10% downside in the S&P 500 from here. I don't think it's apocalyptic.
But 5 or 10% is sort of the limit to you? I ask because there are people who are sitting around right now who are saying to themselves, you know what? This is either a falling knife, and I should catch it now because you can never time it properly, and I should, you know, put more cash into the market. Or there are people saying, this knife, it's got a ways to go. I'm going to hang out on the sideline, and maybe I'll even sell some stocks because I think there's going to be a better opportunity later.
No, I guess the way I think you should engage it, I mean, I'm not going to be able to call the absolute bottom. I don't think anyone will, because it also depends on the reaction of the trading counterparties, right, how much they retaliate. I think it's early to be just trying to step in now, but the way I'm thinking about it is this is an opportunity to reconfigure your portfolios. I think a lot of investors I talk to, by the way, have kind of been awakened to the non-U.S. opportunity and saying, wait a minute, maybe the United States actions have finally jolted Europe out of its paralysis. I mean, let's not get ahead of ourselves, but it could be the beginning of something very good.
We just had somebody on, a guest recently, just in the last hour, who was talking about Europe as a great opportunity. I don't know whether you think that this is their moment all of a sudden.
I think people should really be looking at the global opportunity set. And by the way, I don't think in the last 25 years I've been bullish on Europe. So, you know, it could be the beginning of something really important in Europe. And I'm emphasizing could be the beginning because there are a lot of steps between here and Europe being competitive.
That's a 10-year story.
Yep, it is. It's a long-term story. So what I would suggest people doing is stepping back and saying, okay, there's no rush to be buying into U.S. equities right now. There might still be some downside. And in Europe, by the way, we've had a lot of excitement in the last couple of months. There's been a big run in the DAX, the CAC, the other indices. Give it some time, do some homework, and look at what do you want to own for the next 5 to 10 years. Now, I think you are going to get some very good buying opportunities in the U.S. I'm not anti-U.S. equities in the long run. I just think there's some more downside, more of an air pocket.
For the folks who are already invested in the Mag 7, do you stay there? Do you get out? You know, there's so much of the concentration of this market right now is still in the big tech companies.
Well, the good news is they've derated somewhat from the peaks, so you've already taken some of the pain. I do think you want to be exposed selectively within the Mag 7, but on the margin, I would be taking capital out of those names and moving it to other parts of the market, looking forward. The next part of the whole AI story is not going to necessarily be the same stocks again. I think over the next 3 to 5 years, you're going to see the people who use AI to improve their profitability, improve their competitive position, are going to be some of the bigger winners. So I think this is the time to start reallocating that capital on the margin down the cap spectrum. And I would be looking again outside the U.S. Personally, I think Japan is really interesting. Idiosyncratic opportunities there around capital optimization. I do think at some point in the next 6 months, not today, emerging markets could be a really interesting place. In particular, I would say EM ex-China. I think a lot of this trade tension is going to lead to jobs and manufacturing leaving China and going to other emerging markets, and that could be a real tailwind for those investments. And maybe, just maybe, Europe could be a really exciting opportunity for the next 5 to 10 years, but you don't have to rush to get there today.